Paul, do we go higher from here in terms of yields? And if so, what is the impact of that on global markets? Big question.
Lots of big questions. Good morning, Guy. Everybody's paying attention to those longer maturity yields in US Treasuries. We breached 5% on the 30-year today. There's some key levels coming up. Just a little bit higher than that will take us back to November 2023. And then beyond that, back to the levels that we last saw in 2007. So it's been quite a long time since yields have been this high. People are worried about US spending. They're worried about the US deficit. And they're worried about US policies that are alienating investors as well. And that's why there's pressure on the Treasuries market. All of that extra spending requires extra debt sales. It brings more supply into the market. You need to encourage people to want to buy your bonds. And, you know, if you're using other things that are trying to deter them or risk deterring them at the same time, then that could potentially continue to push up yields and see that steeper curve as well, which is what we're seeing. So that's the risk scenario. If the US can get inflation under control, if the Fed can start cutting interest rates, maybe that acts as a damper on some of those trends.
Paul, talk to us a little bit about what that sell America trade actually looks like. Because, yes, you see it on the long end of the curve, but I'm looking at the front end of the curve, and let's say, or maybe not the front end, we'll call it the middle, the 10-year basically. It's only higher by 3 basis points, where it feels like the equity market is having a more pronounced reaction to it. Walk us through that disconnect.
Yeah, well, today, Kriti, you know, we've got a hat trick, right? We've got a weaker dollar, we've got lower US stock index futures, and we've got some declines in Treasuries and that steepening curve all in one go. And so I think that talks to this idea that there is some souring of demand for US assets in general. I think the really long-term trend is that people think the dollar has peaked. They think that holdings of US assets, particularly the stock market by foreign investors, is so enormous that it can't go any higher and that is going to start to unwind. And that's what some of the money managers around the world have been telling us as well. And so that's the long-term trend. You know, how we get there and what it does to prices over time remains to be seen. But I think that, you know, sort of like a bit of a segregation. And by the way, if you're in the US, the appeal of other markets and putting your money elsewhere, it kind of is only going to grow.
Paul, Chinese data, let's just talk about it. The manufacturing numbers looked OK, but the consumer story still looks very weak. Is that the right read?
More or less, more or less. I mean, you know, so economists have been a little bit too bearish on China of late. If you look at the economic surprise index from Citigroup, it's the highest in about 18 months. So the economy is doing a little bit better than people expected, although part of that is because everybody's been trying to load all those goods onto ships as quickly as they can and get them out the door before all of the tariffs hit, and also trying to find other markets. The consumer is the problem, the risks there. That's what everybody's still worried about, and how you can really get that going again to spur growth is what we're looking for.